Welcome to REBAR Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
To cash or not to cash? Out, that is. Is the market too high? Are we at the mother of all bubbles? Clickbait, clickbait. We're going to debunk that in a second because I got an article that said we're at the mother of all bubbles, bigger than ever. It's the biggest. Are you scared? I am. And if you're not scared, you don't understand the deal. So if I'm scared, like I said, but I'm also fully invested. So how can I stay fully invested and yet manage my emotions and manage the market? Because I don't want to give away the gains, right? So should you be raising cash because markets are all-time highs, that's what we're hearing, or not? And I'll even give you a counter argument that holding too much cash is actually not being conservative. It actually could be risky. You heard me. Holding cash can increase your risk. I know that's counterintuitive, and I explained it on a few podcasts last week, but if you got too much money in your savings accounts, it puts a drag on your total return, and your overall return is too low and lifespans are longer. You won't have enough money to retire. People are living longer. Now, you still got to protect the downside because compounding works both ways. So how can you participate in the market and have sell rules so you can protect your profits but still be in there? So it's a rules-based investing, and it alleviates when the markets are at tops. Now, I know that sounds like an indexed annuity, folks. I know that don't work. I know that sounds like but there are ways to do that. And we're going to talk about that. And we're going to actually talk about the show notes. So in the show notes, I've got a couple of articles that could affect asset prices if you're kind of a asset allocator. Pie charts are us. We don't do that. That's why these articles won't be as relevant to us. But if you're at pie charts or us somewhere, then maybe they will be. But one of the things Fidelity is lowering, no longer starting next year, Jan 1, you don't get the automatic Fidelity cash. You don't get the automatic Treasury money market. It doesn't just default into that 4.5%, 5%. Now it's going to be just like most of the others where you're getting that core money market. It's good, that's only paying 2.5, whatever. And you're going to have to go put the money in the Treasury money market. It's not going to be automatic. So that's one thing. Bitcoin soars. Oh, Teddy Bull's got a smile on his face. Is the Florida retirement dream over? And they're talking about real estate prices. And it's not just real estate that may be affected. Remember, these insurance companies, what do they have on their balance sheets? They've got a whole bunch of real estate because it's like a real estate bond, and they pay their shareholders and policyholders the income on the bond. So they love real estate portfolios. So the insurance companies are loaded with commercial real estate. So indirectly, if commercial real estate takes a hit, insurance companies could take a hit. And my two favorites, though, as always, Jeremy Siegel, that great economist, says it's going to be a quieter year for stocks in 2025. My question is, how does that help you? How does that help you make any decision buying or selling? And then Bob Dole's day of reckoning for stocks. He's talking about a huge bear market's coming. He said, you don't know when, but it's coming. Thanks, Bob. Doesn't help me at all. Now, very quickly, because I want to give you the counter narrative, because here's the narrative. So first of all, holding too much cash can put a damper on your retirement. You don't make enough money and you got to work too long, right? But the other thing is now you're at all-time highs, you're scared to death. You could, if you sell, the market could still go up from here. And folks, you got to be supple enough in your mind that it could go way up from here. But let me give you another perspective, because everybody says the market's so dang high, fundamentals or valuations are very expensive. Wall Street likes to say fully priced, right? And this is an article, The Mother of All Bubbles, from Ruchir Sharma. Now, it's kind of funny because he talks about the idea of American exceptionalism and all this stuff. He said it's hotter than, he said that it's been overplayed. He said there's the U.S. has never been overhyped relative to the rest of the world. He said, however, in investing world, the term American exceptionalism is hotter than ever. He said, never before in modern history are all these other countries clamoring for U.S. stocks. The U.S. stocks used to account for 70% of the global stock index. Used to be 30% in 1980, and now it's 70%. He said, overwhelming consensus, the gap between U.S. and the world is justified because of the earnings powers of U.S. companies and their global reach. But he said the awe of American exceptionalism in markets has now gone too far. Really? How about price is truth? You're wrong, and you're just not making money with everybody else, and why weren't you in here? It's okay if you have a sell discipline. Now, here's the thing that I did like, is they're talking about, like in Singapore, this investment advisor in Singapore asked the audience, does anybody not own NVIDIA? He said not one hand went up. And then he's talking about these other countries that they're in Mumbai in India. The Indian advisors are encouraging their clients to go into American markets. He said even the equal weighted, it's not just big tech, but even the equal weighted stocks, the S&P equal weighted is up 4-to-1, 4 times global markets over the last decade. So here's my question. If we're attracting all this capital and we're the most efficient country and all these and money is coming in here and our markets are working the very best by far, and it's less risky because when you invest abroad, you also have currency risk. So you have 2 risks. So you got to make up for that extra risk. Said another way, if I'm not getting overcompensated for investing overseas, I shouldn't be overseas. You don't need that world global pie chart asset allocation. Whether it's Ray J, Edwards Jones, Merrill Lynch, Fidelity, it doesn't matter. If it's a target date, asset allocation, lifestyle fund, with some rebalancing date, all those portfolios, 60-40, balance fund, all those portfolios, those diversification, when it hits the fan, they all grow together. Those correlations, those portfolios move in tandem, whether you're a number 8 conservative or a 16 aggressive, they are a lot more highly correlated than you think when it hits the fan. That's why you got to know how to get in and then how to get it out. But once you get out, how do you get back in? That's a very good question. So in any event, we're going to talk about all that. I do want to get to the mailbag here it is, right here. So we have the mailbag, and I'm going to do this in reverse order because this will set this up perfectly, okay? Now, the reason I'm giving this first one is this is one of the advice given, not just by Schwab, but by many people, even advisors, that's terrible advice. So, hi, Dan and Don. I'm a follower of your content across several channels. Appreciate your approach and philosophy. My question is about account ownership. I have a power of attorney on my mom's assets, and while I enjoy doing research and trading on my own, I'm crunched for time. With a full-time job, couple of teenagers, and elder care. Sounds like the American dream. Is it possible to create an account with you all with some of my mom's money via POA? Also, do you share any information on historical returns? Don. Hi, MD. Apologies, the original did not come. You absolutely can support the scenario. Dan will reply with more info and returns. And then me, if you have durable power of attorney on your mom, we can open the account for her and we can transfer the assets via TOA. And if you do not already custody there. So then he comes back and said, getting back to this, I have a question. Schwab suggested opening a joint account with my mom as the primary and me as a secondary. Therefore, the account is under her for tax purposes. I just wanted to check and see if this type of account works with Revere as mentioned in the email. Thanks and have a great weekend. I said it would work as far as us managing the account, but Schwab is completely wrong with that advice. This would make your creditors your mom's creditors, and if you got sued, they could attach to your mom's assets. Also, now you are jointly liable for the taxes on the account. What happens with the step up in basis when your mom passes? Half the account could be attributable to you. And lastly, it could possibly screw up your own estate planning. For these reasons, I think it is actually terrible advice. A much more elegant solution is to simply add a durable power of attorney on your mom. This way you could act on her behalf. If you were the owner, just as if you were the owner of the assets, but not legally the owner. The above example you've now legally added with your Social Security, albeit as secondary. Schwab even has their own power of attorney form that you both just need to notarize. Thanks. Folks, you would be surprised at how many people, and they're trying to do it to help their parents. They're, in assisted living, and they're trying to take care of their stuff. Don't add yourself to your parents' accounts. It's a big mistake. Hang on one second. Excuse me, I needed a drink. All right. Now the second one, and this is the one that's relevant for today and what we're talking about, because I'm getting these questions all the time now. Good morning, Dan. Just wanted to touch base. My Jan 5 pay, there's a client, obviously. My January 5th payment on the second half of my home purchase, need to pull out $200K. I opened things in Schwab, and of course things look great right now. I've got 60 grand in cash. Emailing because obviously if I'm going to need that to pull that much out, is it better to do when we're at when we're at highs? So she's assuming, and we are right now. I just need your feedback and some type of timeline plan. You're welcome to email me or text me. Thanks. That is what is great about Grotection. It trails up the stops to protect the lion's share of the profits. It doesn't mean you couldn't go down some, just that it's limited. But it could go up I could go up another 40% from here in the next 6 months or a year, regardless of your beliefs or mine. I believe it is not, I believe not only is the market very pricey, Wall Street likes to say fully priced because they never want you to sell, and overpriced would evoke selling. But also I see the market acting very well and wanting to go higher, at least for now. You have to be supple enough in your mind and believe and accept that the market could go either way, -40, +40% within the next 6 months, or anywhere in between those ranges. The assumption that the market is pricey, and it is, and therefore cannot go higher, is wrong. In other words, just because it's pricey doesn't mean it can't go higher. Price equals truth. All that said, January 5th is coming soon, and that close in time, we do need to plan for. So thank you for the reminder. I've copied Don so he's aware, and Meryl to do the raise it, send you the money. And I was telling her about you doing the end of the year, so no hangups, because the end of the year, folks, they also get very busy. One last thing before we go to the team, folks. Around the holidays, all the big custodians, the broker dealers, they're kind of at half mast because they let half their staff go a week before Christmas or Hanukkah, whatever, and then a half afterward. And so they don't have as much staff as they normally do. And it's also the busiest month of the year because everybody waits to the last month to do all their RMD, their required minimum distributions, or any kind of tax planning. So it actually is very busy while they're almost at half staff. So if you're going to do any RMDs or you're going to do anything like that, do it in the first 2 weeks of December. Do not wait till after the 15th, then it can be on a best efforts basis. Lastly, we don't have to worry about doing tax planning because we keep our losses small, so we're actually doing tax loss harvesting on an ongoing basis, just the way our strategy works. But if you, and I cringe when I say this, if you've got a pie chart, asset allocation, pie charts are us, if you're going to do your tax planning, you should do it now. Don't wait till the 28th, because the stocks that have losses, everybody looks at the stocks that have losses and they go and book those losses. Well, the loss, you don't want to get a bigger loss. So the stocks that have the biggest losses tend to continue to go down through December because everybody's booking those losses for their taxes. So normally the professionals will do their tax loss harvesting in late November or early December. Anyway, with that said, everything that I've been hearing this last week is, oh my gosh, I'm scared. The markets are at highs. And you guys, man, look at my account. I can't, it's just, you guys are doing great. What now? I don't want to lose it. I don't want to, I'm scared. I'm scared. I agree. You should be. But if you have a plan, that can alleviate the fear. Just like health insurance. I'm scared I'll get sick, but that's why I got health insurance. So Don, what's our portfolio insurance?
Our stops, Dan.
Oh, baby, come on. Rebar, Don, rebar.
That's right. Well, let's talk about rebar. Let me bring in a screenshot of the spreadsheet. This is like my favorite time of the day is when after the market settles down in the morning, I go into the spreadsheet and I get to raise the stops on all of our positions. Now, what that means is it locks in gains because it reduces the downside, the balance at risk, because the stops are going up. If the stops don't, they're based on a combination of moving averages, how long we've held the position, and the general overall market factors into it occasionally. We will tighten some stops up if things were looking like we were in the process of selling off or we were breaking moving averages. But when we're trending the way we do above the 200-day, 50-day, 21-day, and 8-day, all I really end up doing is raising these and locking in gains. Do it once, maybe twice a day. But all it is a lot of it is when you're in a strong rally. Let me go back to the overall market, because this November and early December is acting a whole lot like last November and early December. We came off the lows. In the beginning of November, we had a strong follow through day, and that kicked off the rally that's been going on now for 13 months. And we trended through the end of the year above the 8-day moving average. The 21 wasn't even factored in for those 2 months. Only in the beginning of January, and this is kind of something that we expected, and it's our base case expectation for the beginning of January now, is that a lot of gains from the prior year, people will wait to the beginning of January, sell some to defer the taxes by a year. And you can see the little pullback at the beginning of January last year. The first couple days, all we did is come down to the 21-day moving average, and then we rallied again above the 21 all the way into the end of March. Not saying that that's what's going to happen now. That's one scenario, and that's what things are acting like right now. One of the differences between last year and this year is that we hadn't rallied for 13 months. In the situation last year. So people were more than willing to just let things ride higher, but the letters we're getting, a lot of analysts, a lot of portfolio managers want to protect the gains and might be more willing to lock them in sooner, especially if it's in a non-taxable account. You can sell to just lock some gains in.
Right.
It's normally the taxable accounts that they delay to the beginning of January. But back to this process that we go through. The initial buys are normally sized against the 8-day moving average, because in a strong market, and this is if we're not buying a breakout from a base, but if we're entering something that has been maybe trending for a little while or is just coming back into a reasonable buy spot, size it against the 8. When the 21 gets above the cost basis, move the stop up to the 21. When the 50-day gets above the cost basis, move the stop up to the 50-day on portions of it. On gaps up, we use the low of the gap up day until we can get an 8-day moving average up into there. On a longer term basis, we have stops for our index portion of the portfolio, going all the way down to the 200-day, the 150-day, and the 100-day, or 40, 30, and 20-week moving averages. So just like you said in your reply to the email, we raise our stops. It's a process we go through every day, monitoring, because we just know from history that the strongest markets trend above the 8-day moving average and 21-day moving average on the indexes, and the leading stocks will be doing the same thing. So it's just part of our process. Somebody commented on our YouTube video last night, I think I'm calling a short-term top. I mean, what is the point in making any call?
Well,
Just
you
let
call
the
yourself an
market.
economist then.
Yeah,
Sorry.
just let the market make the call for you. And one thing to think about is why are we trading where we are? And it's pretty simple from an academic standpoint. And this is like really the only useful reason for analysts is that they project earnings going forward for the S&P 500, and the market puts a multiple on those earnings. Right now, it's between 22 and 23%. If corporate earnings are continuing to grow, why would the market drop? I mean, you might see some contraction in the multiple. You could go from 23 to 22 to 21. We could pull back a few percent there. But as long as the economy is growing, there are no shocks going on or no black swans. There's no situation under which corporate earnings stop growing. If they continue to grow, and they're slated to grow all throughout 2025, that implies that if the multiple stays the same, that the market is going to continue higher.
Yeah, let me let me break it. Let me just explain that for the layman, because that's a very salient point, folks. Everybody thinks so the price to earnings is the measure of how expensive stocks are, and historically it's close to all-time highs, 23, like Don said, 23 price to earnings, right? There's two ways that can come down, though. That's what Don's saying. So you can correct, the market can go crash and go down, so the price comes way down, and therefore the price to earnings comes down, or earnings can accelerate the become bigger, and it makes the price to earn, so they can grow into the price. The earnings can catch up to price, and therefore it's not as expensive. Said another way, if a stock is 100 PE, it's got 100 PE, and it's got a growth rate of 100%, next year its PE is 50. If it's still growing at 100%, next year its PE is 25. That's what Don is saying. So I just wanted to he said it. That's exactly what he said. I just wanted to make sure that people that are just joining that aren't stock nerds, pulled that up. The other thing I want to say, Don, it's kind of funny. You're talking about your stops, how sophisticated your stops are. So folks, here's what I want to ask you. Are you just is your advisor or you just using a plain 5% flat stop? You're not doing any sophisticated thing, and each stock has its own unique stop loss? Because if you're doing that, you're just doing a hard 4, 5, or 6%. The market makers are using you for fodder. They're raping retail investors all the time on using hard stops. In fact, we don't even use hard stops. We we get an alert sent, and then we go put in the appropriate order. The last thing I'd like to say is, you heard how Don explained all that, how technically he got. Is your advisor explaining and getting that technical with the markets like that, or is he asking you what tea time you want? Just a question. Go ahead, Don.
Yeah, so we've been on all of our morning calls for the last couple of weeks. We've just been, ending the call with, keep raising your stops and ride the wave. There's not a whole lot more to say when we've got the coveted 4 green arrows on our trend gauge, which means market leaders are acting great, and all the major indexes are trending above their long-term 200-day moving average, medium-term 50-day moving average, and short-term 21-day moving average. And then as an added bonus, if you're really trending strongly above the 8-day exponential moving average. And that's why we discuss these every night in the videos that we do. Ted and Connor are just doing a fantastic job on the videos. We keep a consistent theme across the team. There's a same format that we use. They use a couple of different tools and a couple different trading platforms to add a little bit of additional insight to some things that I show. But stick with it. We have a track record of staying on the right side of the market and not guessing, but interpreting the market and letting anybody that follows us know in our videos when things are getting dicey, or to extend it to the upside. We did take a little bit of SSO off the table this week when the S&P got 3 ATR above its 21-day moving average. That's
average
just one of the Yeah, average. It's just one of the discretionary things that we do here as far as locking in gains when you get a bit too extended to the upside. But normally, it's not until you get 5 or 6% above the S&P 500 that you have to be concerned about that. But sometimes we take action to lock in the gains. And then, like I just showed on that chart right now, our downside is a little bit more than 9% if all of our stops would get hit. And that wouldn't happen all at once unless, a meteorite landed in New York City or something like that. But day by day, level by level, there was a lot of numbers on that chart, but it really is based on maybe 5 rules. And it's just a matter of applying those rules to each position.
So let me ask you a question. So folks, a lot of this is actually, so what we're actually measuring with price and volume, we're measuring what is happening while it's happening and making adjustments accordingly. So a lot of this we're actually measuring what the investors are doing with buying and selling, the demand for stocks. So emotionally, like I told you, I've got all these feels from clients and prospects saying the market feels toppy. Are we taking profits? Are you going to sell? How are you going to protect? Those are the questions I'm getting. That's the sentiment. That's what people are feeling across the country. Therefore, people are going to be more hesitant to buy. Buying's going to slow. The market could pull back, right? Then once the market does pull back, then people start going, ooh, I'm going to start easing in. It looks like it's a good opportunity. And you start getting buying in. So a lot of this is actually emotional. This is actually the people's emotion being played out in a chart. And that's what we're actually measuring. And now, the question I wanted to ask for you, though, Don, is this part of the market where we always say every morning right before we hang up, right, just keep riding the wave. We're just riding the 21, right, ride the wave. Is this the easier part of the market for you to manage? Or, is this easier time once you got most of the positions in place and –
It is, because we haven't been doing a lot of trades because we've had our positions in place when the market got healthy and held the gap up after the election. We had not as much in place. We had an adjusted beta of about 1 going into the election because we were sitting right on the 50-day moving average. It could have gone either way. It could have broke through the 50-day moving average and came down and tested the 200-day, which in other words is going from the red line to the black line here. But it didn't. It gapped up. We added to positions at low risk entries like we always do. And it's easy from the standpoint of just letting the market continue to do what it's doing. It's when it starts breaking averages that there are more decisions to make. And really, it's the system giving us the decisions. Okay, we break the 21. It's just if then else. If this happens, then we'll do this. Otherwise, we'll just leave it alone or watch for something to get too extended to the upside, maybe do some offensive selling. But our rules are there for a reason. They keep us in when we're questioning whether or not we should still be going. I compared this back to November, December of last year. It's more appropriate to compare it to November, December of 2020, which is when we were coming after COVID and there was a big, strong run for growth stocks. And that continued into the first month and a half of 2021 before growth stocks crashed with a big thud while the indexes continued to go higher. But small and medium-sized growth stocks, and that coincided with a breakout in the 10-year Treasury, and that's one of the reasons why we do inter-asset correlation every night in our videos, because these things have an impact on another. Depending on what state interest rates, the dollar, and the overall economy dictates what the market's going to do, and really the market, they say, looks forward 6 to 9 months. So what's going on right now may be indicative of what you see down the road, but there's no substitute for just obeying the price and what the market's doing. And that happens for the upside and the downside.
So right now you're saying what you're saying is mechanically less rules are getting triggered right now because it's
Right.
kind of
The
a
rule,
smooth
yeah.
uptrend. Yes.
Yeah,
Got it.
the rule, right.
Yeah.
The rule
Yeah.
is, ride the wave.
Yep.
Let it
Yep.
go. If you get
Yep.
too extended to the upside, take a little bit off the table, but always keep an eye out for new opportunities. We got two new opportunities.
It's when the wave breaks that you got to do something. That's when you really got
Right.
to. That's when you got to pay attention. I mean, you always got to pay attention, but that's when you got to take more action. All right.
Yeah, the trend is your friend till the bend at the end, and that bend for us takes place over four decision points. One, what are leaders doing, and then two, what are the indexes doing across the short term, medium term, and long term moving averages.
All right.
So that's where we are in the market.
The bend at the end, so it's not the bend yet. It hasn't bent yet, right?
Right. All three time frames are fine. Look back here to July. First, we bent at the short-term 21-day, then we bent at the medium-term 50-day. We got down close to the 200-day before bouncing. When we start regaining these moving averages, we're always taking a look at what are leading stocks doing, what held up the best during the pullback. That's what separates the contenders from the pretenders. And it's just a matter of following the rules. Like I said, there's really maybe five big rules that we follow. And then it's keeping an eye on the market, keeping your finger on the pulse of the market. What message is it giving off? And then, of course, the inter-asset correlation.
Yep.
And how that impacts with it.
Yep.
So right now it's, summarize it by ride the wave. That wave, we're going to see the 21-day moving average come up through the 6,000 level. That was a resistance area back late October, the beginning of November, which we finally broke through. A couple weeks after the election, we came back, tested, and are putting distance between the 6,000 level. I think I said a couple times this week, as long as we've got a 6 handle on the S&P, that's good. But at some point, we can still have that 6 handle. But if we start to break the 21, then you got to pay more attention to what's going on with leaders versus their moving averages, in addition to what's going on with the market against its moving averages.
But right now, Jesse Livermore is smiling.
Yeah, he is, and keep the gun away from him, obviously, at all times. But,
oh, wow, ouch. Yeah.
Yeah, I mean that's kind of a crazy ending for poor Jesse. Anyway,
yeah,
a lot of lessons in that book. All right, let's turn it over to Connor because he's going to take a look at a leading sector, which we noticed a couple of weeks back, and it really has kicked in strength. Connor, take it away.
Yep. Yeah. So we mentioned IGV a couple weeks back, and this has been just one of the best sectors to be in the market right now. And if you look at this chart, it's making new highs again today. And then recently this week, we've seen some earnings from other software stocks that are just confirming the strength in this group. And if you go to the weekly, Don, on IGV, you can see, although on the daily, it is somewhat extended, and on the weekly as well, but it is just coming out of a huge multi-week base. So when you see things come out of a larger time frame base with volume and continuation, that usually is the market telling you that this has a lot of room higher to go to. So I just wanted to show that ETF chart to start because I really think software should be a major focus into 2025. Obviously, we can't make predictions, but given how well the group is acting and how many stocks are doing well there, that could be a trend. And one thing I noticed is this is the same kind of feelings that semiconductors gave in 2023. You had just a ton of semiconductors coming out of bases, gapping higher on earnings. And that was over a year run for many of those. So that is a possible, scenario. But so that's the ETF. And if we look at some of the names, CRM's the first name I want to talk about. This is Salesforce, and this recently just gapped up on earnings. And although their earnings and sales weren't as explosive as you see in other things, I think what the market really liked about this one is how they emphasized the data cloud as a critical foundation for AI applications. And they also mentioned that estimates for that AI cloud could generate an annual increase of $4 billion from AI monetization in the coming years. So it's sometimes you have to dig a little bit into the earnings to really understand what the market liked, and from that's how I took it, is them talking about that and really what AI could bring to them as a company. So that kind of checked the box. And then just from a pure technical perspective, this is just coming out of another big base, and this just another point that fits of a lot of bullish action in the software stocks. So that's CRM, and then another one is Team Atlassian, and this has been a monster one as well. Really, you can't ask for better action after an earnings gap. It gapped up on day one, never gave you any pressure into that day low, and it's just been riding the moving averages higher. And this one, again, didn't have like super explosive sales or earnings growth either, but they did say they're tapping a 67 billion addressable market. They're aiming for 10 billion in annual revenue. And then they also collaborated with AWS. That was another thing. And one last thing is their cloud revenue was up 31% quarter over quarter. And Don just pulled up the weekly chart. I mean, this looks really good, and it's definitely coming out of a big stage one base. So, could have a lot more upside potential. And then Datadog's another one. This one really just started springing out of a base as well, and it's been falling through very strongly. Not much to comment on this one besides, I mean, that's just a great looking chart pattern, and it's moving higher. Obviously, it's short-term extended. It's hard to get a spot into these names, but they're just definitely worth watching. And you've seen, you can use a variety of entry tactics to get in. Don talks about the 60-minute stochastic quite often. And that is another thing, is when you're in a strong market, you're not always going to get that picture perfect A+ setup that, sometimes that we want. It's more so if stock's moving up, that means there's buyers in it, and sometimes you have to get more creative to get in, and that 60-minute stochastic is a good way to do that. And then, so those are like the three top leaders that I like. Tough to, not really in the most viable positions right now, like I mentioned, but they are showing leadership. And then, Don, you don't have to go to these charts, but I just, for the viewers, if they want to look at some other software stocks, I'll just list a couple. Shopify, ticker SHOP. You have Adobe, ADBE. GitLab reported earnings today, and it was up. It was a really good report, but it's actually coming back in. Not the prettiest candle that it's putting in today. So we'll have to see how that reacts in the coming days. Snowflake, which we own in-house, which is acting great. Twilio is another one, TWLO. That one also sparked off an initial earnings gap out of a base. You have Samsara, that is ticker symbol IoT. Definitely a little bit more choppy, but that one is clearing out of an IPO base high. And yeah, you can see it's down today. That's one that you're better off to buy that one on weakness versus strength. It tends to squat after breaking out. And then Cloudflare, ticker NET, is another one. So, you can look at all those stocks. I mean, there's just an overwhelming amount of stocks in this industry group that are acting well. So that will give you a big picture view of what the sector's doing.
Great overview, Connor. And I think one of the most important things that you mentioned is drawing the comparison to what semiconductors did back when they broke out last December from this long base. And while look at the relative strength line on the weekly in semiconductors. While this has formed a base and shown relative weakness, it's been software that has picked up the mantle for it over the last couple of months, and very similar now to just breaking out to that higher high and starting that run the way semiconductors did back last November. Good comparison there. Thanks for that. We are going to turn it over to Ted now. And Ted is he's going to actually take control of the screen and show some crypto charts.
Yeah, perfect, Don. So This is a pretty big week, as Dan mentioned earlier, for Bitcoin. Yesterday, we officially hit 100,000, but it definitely wasn't an easy day, as you can see this daily candle right here. We broke out and put in highs of 104,000 yesterday, but after the stock market closed at 4 p.m., let me go on a 5 minute actually to showcase the mini flash crash we had in Bitcoin after hours. You can see we closed around here and we had a quick flash crash of about 7% all the way down to this 92,000 level, but that recovered quite sharply. And today we opened back up around 98,000. We're putting a really tight inside day, still above the downtrend line, and we're back again looking at that 100,000 level. This remains really strong, and how I would interpret this price action of yesterday, that the thing with Bitcoin is that there's so many exchanges and so many people taking leverage positions with these instruments called perpetual futures. So they're futures contracts on crypto that don't have an expiration date like what we have on futures with equities, commodities, and fixed income. And when a lot of people pile in and when funding rates get high, and what funding rates are is the cost you have to pay to take on the leverage. If it doesn't go immediately, if Bitcoin starts stalling, all these leveraged longs will start selling, and that often can lead to a cascade of sellers that liquidates all the leveraged longs. And that 97,000 level was a liquidation spot for Bitcoin. And really, we hit that and we sold off hard, but recovered nicely. So leveraged longs are cleared out. Probably short chasers too are probably washed out. So this definitely neutralizes things, and it's actually in a way even better to get those weak hands out. Strong hands definitely stepped up to the plate here around 90,000, 92,000, and now we just look towards 100,000 again. Continue on. I talked about Ethereum potentially being that pitch. I mentioned it somewhere down in this area, and I wasn't as interested just because the daily moving averages were still entangled, and same with the weekly, as you can see. It's just not aligned right now. We did get the 10 and the 20 cross, but still below the black 40-week moving average and the purple 30-week moving average. Those are all starting to trend up, but really ideal situation is 10 above the 20, above the 30, above the 40. And I've never really witnessed a big move in any security or asset without those moving averages in line. As you can see back here when Ethereum made this 160% move, those MAs were all aligned. If we go back to Bitcoin weekly chart, you can see this breakout had the 5, 10, 20, 30, and 40 aligned. And if
Yeah,
you
it
go back
forces
a
them. It
little bit
forces
to the
them to
late,
line out. Yeah, it
exactly,
forces them. Yeah, yeah.
exactly. And so pretty much with Ethereum right now on the weekly chart, how I would see is that the entangled moving averages are almost going to act as a force that will eventually pull in Ethereum. But obviously, anything can happen in the markets. If momentum is extremely strong, we could just overshoot above 4,100 and then put in a consolidation up there. But in this game, talk about probabilities, and for a sustainable big move, the probabilities is that this needs to have some back and fill action, whether it's below 4,100 or you can overshoot and then put in, as you can see, like higher flags above the base as well. So pretty much the ideal situation, what I'm looking for with Ethereum, we broke the 4,000 level, which is huge today, but we do have this 4,100 now above. So you can see it's straight off the bottom, and William O'Neill talks about straight off the bottom tends to be much more failure prone if we do break out. So ideally, maybe a week, a few weeks, maybe 2 to 5 weeks sideways, and then we take on 4,100, and that'll really be a nice setup. And the ETFs that we would look at, ETHA is the 1X. You pretty much just have to look at Ethereum because this chart is all over the place because they just came out with it. You really have to watch the Ethereum spot price. If you want to use some leverage yourself, you can use ETHU, which is another way to play Ethereum in the equity markets. And continue on.
That's
Solana
a tiger. That's a tiger by the tail, though. If you're going to do that, you better know what you're doing.
Definitely.
Yeah,
definitely even more volatile than Bitcoin. And then Solana is even a higher beta play in crypto. The reason that's really popular is It's a lot cheaper than Ethereum. Gas fee is a lot cheaper. And so many developers have switched over to Solana because of the lower costs. And those who pay attention to the meme coins, most of those aren't developed on Solana. And that is why there's a lot of inflow interest in this name. Just going back and reviewing what I talked about in the past on the podcast. Right here, if I go back to this day, I mentioned this really looked like MSTR high type flag above the base. If I were to go to MSTR and do that comparison again, you can see we ran up the right side, built a higher handle, just like Solana, if we were to go back here, and then we both broke out as well. And so far, we made a nice move, about 20% move, and we hit this 260 level. You can't really see it on this daily chart, but if I were to go back to a weekly chart, that was the previous all-time high of 2021. So clearly the price action is telling us now that there's still some sellers and bag holders back from 2021, which is quite amazing that they hold through all this period of chop, being down, sometimes even 90% plus, but found some resistance here, pulling back, and we're really seeing a nice flag develop here under this 250 area and 260 area. This is kind of what I'm watching now. So maybe a breakout above that downtrend line, but then the key level is really 260. So that's what I'm watching there for those who do want a little bit higher beta exposure in the crypto space. You want to check out the exchanges that you can use to buy these cryptos. I talked about it on a previous podcast as well. And yeah, the fourth coin I want to talk about.
They could just reach out to you. Yeah, they could. If folks, if you want to know about the exchanges, just Ted at revereasset.com. He can give you information.
Right. Yeah, exactly. Actually, one last thing about Solana. I believe a Solana ETF has been filed, and that will be coming out in the near future. That's just another way to play that in equity markets. And these instruments are actually really nice because you don't need to take that risk of where do I store your coins, counterparty risk with crypto exchanges blowing up on you. And
you're talking about with ETFs.
Just a nicer way. Yeah, exactly. And a lot of people's money are in IRAs, Roths, 401ks, which they can't just easily withdraw for crypto.
Yeah,
that's going to be a nice way to play this as well.
So Ted, let me ask you one more question. Sorry, I didn't mean to interrupt. Are you only Bitcoin, Ethereum, and Solana? Or are you doing some of the minor league players? Do you follow the minor league players?
I definitely follow some of the minor leagues, and I'll actually talk about one right now, Dan. So SUI, I guess I'll call it SUI. This is a newer one. Let's just first go on the weekly chart. As you can see, it ICO'd in May of 2023. And really, it's just amazing when you look at these charts over and over again. Supply and demand, human psychology does not change. Big move up, pull back, correction, nice move up the right side, found resistance, previous left side peak, built this nice handle and exploded out. And this has really made a really fantastic move, 100% move out of this cup with handle. And we saw that in Bitcoin, cup with handle. We're seeing it in Ethereum. We saw it in Solana. And just really want to emphasize, technical analysis, price action is the reflection of buyers and sellers over time and their psychology. So it really works. And going on to the daily chart, it really has model book price action, just surfing the moving averages perfectly. When it does pull back, it's finding support at the 50 at key moving averages, undercut and reclaiming them, then wedge pop, pulls back again, builds a higher low, breaks out of that downtrend line, and we're taking off here. And now we've built another continuation flag, which could be a pyramid spot, and we've broken out so far again. So SUI is another, what it's called layer one. So it's its own blockchain, like a Solana, like a Ethereum, like a Bitcoin. And I don't know too much about the fundamentals with this, but I just know the themes and the macro picture in the crypto space. And I know this is even higher beta play than Solana if you want to go further out on the risk curve. And I'll quickly review two cryptos I also talked about in a previous podcast. I did not imagine these moves back then, but let's just quickly talk about it and then we'll wrap it up here. So I talked about this weekly chart on light mode real quick. And I think it was this week right here. And we had a big move up. I was talking about how we just broke the weekly changing character, which is about the 16-cent level. And so far, we've really just went much higher. From that 16-cent level, we went about 250%, and we're really digesting this big move nicely. This is another one I am stocking, but I do want to see that 50-day catch up a little bit, and just see how this builds out, because after a 700% move, 600% move off the lows, you really need to see and let just supply and demand work itself out. And XRP, same thing. They pretty much are in the same theme with financial payment processors, cross-border payments that are fast and cheap. So that's the theme here. This actually has been even stronger since the move off the lows. It's 140% move, and it's pulled back about 23%. But in the grand scheme of things, as an ADR of 16%, so it's only a little bit above one ADR. So it's definitely normal price action. And we just want to gauge whether something is normal or abnormal. And so those are 6 cryptos I'm stocking. There's definitely more if you want to reach out to me. I pretty much just track the top 100 market cap. We don't talk about meme coins, because to us that's more of gambling than anything. So that's it with this segment. 6 main cryptos I track: Bitcoin, Ethereum, Solana, SUI, XLM, XRP. There's some even higher beta ones I do track, but these are the main ones.
So the question is, did your crypto ICO? So that's initial coin offering for those that don't know. That's what he mentioned a little while ago, like IPO, initial public offering for a stock, and ICO is initial coin offering.
Right.
So do you have any ICO cryptos, or are you old school? Well, either way, we could help you. Revere can help you. We could look if you want to do stock. And by the way that we easily do it is we do it through ETFs, because they're very easy. At some point in the future, Schwab and Fidelity are both kind of toying with allowing direct crypto into their accounts. But, right now, for the most part, you got to open up, a crypto exchange, a separate thing. Regulations are they're still trying to figure that out.
As we're talking, Dan?
Yeah.
As we're talking, Bitcoin is back above 100,000. So that's nice to see.
One last question, Ted. Is there a basket crypto ETF that's got I know there's one that's got, Bitcoin and isn't there one with a couple that's got the two main?
There's WGMI, but that's the miners.
Okay. All right.
Yeah.
All right. Well, folks,
that's it for me.
Yeah. If you need to learn anything about crypto, Ted and Connor, they follow this, especially Ted. He loves it. It's everything crypto. He follows that stuff. And they're pushing it. The government is now on board. They're going to start regulating it according to the Trump administration. They're going to figure out how to do it. Companies do it. And really, it's that blockchain technology behind it. It's actually the security is why everybody likes it. So it's coming. Or are you going to be in the horse and buggy, or are you going to come and buy an automobile? I don't know. I'm a little old school. I still think you ought to have some physical gold. Just call me crazy. Don, do you have anything else?
You're crazy.
Oh, well, thank you, Don. I just said that. All right. Folks.
No, I do have one thing to consider. Crypto got a pop this week. Trump nominated a very crypto-friendly SEC commissioner. That was noted as one of the reasons. Gary Gensler, the outgoing, did everything he could to keep crypto ETFs from coming onto the exchanges and out of people's IRAs and personal accounts. But the barn door's open and the horse has left now, and you've got a new rider coming in. So it's gonna get easier to invest in them.
Yeah, and folks, listen. Being apolitical here, you like John said, you got a new sheriff in town. They're different. There's going to be different losers and winners, and all these people say they kind of know what is going to happen, but they really don't. But the stock prices tell you price equals truth. It tells you what the markets believe in real time is going to happen, and as that unfolds and it plays out in real time, that opinion will change and it will be reflected in price. And so we will make adjustments accordingly. At Revere, we always say it's okay to be wrong. It's not okay to stay wrong. That's why we're comfortable. I started the show, how do I stay invested when I'm scared to death? Because we have a sell strategy. It's a lot easier to get in when I buy. I already know where my sell stop is. I already know where I'm going to sell. And by the way, if you don't know where you're going to sell that to minimize losses, you can let it ride up and trail it up. But if you don't know where that stop is before you buy the stock, you're a rookie. If your investment advisor doesn't know where his stop is, or she, before they buy your investment, they're rookies. They're just buying something haphazard. Oh, we'll just put it in a drawer. You can buy this, it's a dividend stock. You can just put it in your drawer, set it, forget it. How'd that work for Enron? Don't forget, GM shareholders got wiped out in 2008. I got the whole wall of shame. American Airlines, Wachovia. There's a whole list of them. What is your money in? Find out a better way to invest at Revere. Just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. Just tell your friends, tell a friend, tell a neighbor. They can just go there, sign up. They'll get this podcast every Saturday morning. We record it Friday morning. And if they go to YouTube and just search for Revere Asset, Zach will have this out by noon or 1 Central Time, and you'll have it before the market close. That's what our stock nerds to do. In addition, we do a video every night the market's open, 10-minute video. We actually tell you what the markets are doing, their strengths, and what we're doing actually in our portfolios for our money and our clients' money. They're one and the same. And you can always call us old school at 855 Real Wealth. We'll talk to you next week on Your Money.
It's not about how much you make in the markets. It's about how much you can keep.